So in today's video, I'm going to be going over how much house can you qualify for, how much can you get approved for. Number one, I'm going to talk about how the banks calculate this so you can do your own calculation to see how much you can get approved for. And two, I'm going to be going over a real life scenario using $75,000 of yearly income. And three, how much down payment do you need and should you put down 20% for the down payment? And if you're new to my channel, I'm a mortgage broker. I'm licensed in 48 states, and click the link in my bio, give me a call if you have mortgage questions, if you need to plan out to buy a house, I'm here for you. And you can call me directly. My number is 407-773-1775. Either me or one of my team members will answer, but we'll always call you back and we'll always answer your text. So let's get into it. Here's how all the banks calculate this. So your pre-approval amount, the amount that you can buy, is directly dependent on how much income you bring in and how much debt you have. It's not driven by credit score, and a lot of people get this mixed up. They think that just because they have an 800 credit score, they're gonna automatically get approved, and that's not the case. Credit score really helps with the interest rate that you get, so the better your credit score, the better your interest rate is. But as far as getting your pre-approval amount, that's directly dependent on income. And this is how they calculate this. So they look at your monthly income, and they look at your gross monthly income, not your net. They subtract your monthly debt, so the minimum monthly payments for that. And then that gives them what your residual income is. So the amount left over from that, you divide it by 2, which is 50% of that amount, and that will equal the amount of mortgage payment that you can afford. And as far as monthly debt, a lot of people don't understand, they don't have like a clear idea of what that is. It's basically really anything that's on your credit report. So they look at the monthly payment of student loans, car payments, any installment loans that you have. They look at if you have any child support payments that you make. They use that, any alimony, pretty much any installment or revolving loans. And it's important to note, they don't really care about the total amount. It's mainly the monthly payment. Now, what's not considered debt is your rent amount, utility bills, your insurance, your cell phones, things like that. So really what the banks care about, the number one thing is the ability that you can make the mortgage payment at the end of the day. Okay, so let me walk you through a real life scenario, how this looks on paper using $75,000 a year of income. You can do this with me and you can plug in your own numbers that pertains to you. But $75,000 a year, you're gonna divide it by 12 because there's 12 months in a year, and that's gonna equal your monthly payment. Now remember, this is your gross, we don't care about your net. Then we take your monthly income and we subtract all of your monthly debt that you have. And that's going to equal, this is your residual income, so the amount that's left over after subtracting this. Now the banks allow you to borrow this amount, 50%, so you just divide it by 2, and this is how much mortgage payment that you can afford. And the mortgage payment, this includes everything out the door. That includes the homeowner's insurance, taxes, the mortgage payment itself, the P&I, if there's any mortgage insurance on it, and also if there's an HOA. So everything, that's the max mortgage payment. So after doing calculation, here's like a quick breakdown at a 6% rate. This is going to equal to about a $320 loan amount, which if you're putting 3% down, which is the minimum down payment, it's going to equal about a $330,000 purchase price. Now, it's important to note, and this tripped a lot of people up, when the interest rate is lower, it's going to equal a cheaper payment. So back in COVID, when the rates were in the 2s and the 3s, you could qualify for a lot more because the payment was a lot cheaper versus when rates went up to the 6, 7, it hit 8 almost for a little bit there. So that's why a lot of people were surprised that didn't buy in COVID, that their pre-approval didn't match the amount years later when the interest rates were higher. Okay, so here's a breakdown. I'm using $330K as the purchase price, but if you have an FHA loan, the minimum down payment would be 3.5%, and this would only be for buying your primary residence. VA loan, that's for veterans, active military, surviving spouse. They have no down payment on this loan. It's also for buying primary residence only. On a conventional loan, If you're a first-time home buyer, you're buying your primary residence, the lowest is going to be 3%. And if it's not your first rodeo, then it would be 5%. And if you're buying a investment property, it's 20%. Now, USDA loan, this is for houses that are in rural areas, USDA approved areas, and there's no down payment that's required on those loans. So should you put 20% down or wait to save up? I probably get this question on a daily basis, and here's my thoughts on this. So if you're buying an investment property, yes, you have to. That's the minimum down payment. But if you're buying your primary residence, you're living in it, no, you should not. And here's my thoughts on this. Number one, you want to let the banks carry the majority of the risk. Number two, you don't want to be house poor. So what I mean by that is, number one, you don't want to stretch yourself, obviously, as far as monthly payment to where you're not able to catch up and save. And number two, you don't want to put all your life savings into a house, or majority of your house savings, because one, emergencies happen. And I mean, the list could go on what if and what happened, but we just had major hurricane here in Florida, and a lot of people's property has been damaged. Yes, home insurance does cover this, but you also have a time lapse. I mean, there's a lot of variables into this, and even into life. Number two, there is a cost of waiting. So for example, pre-2020, I bought a house. I bought a house for $200,000. I put the minimum down payment. Now, had I waited to put down 20% in a matter of just a couple of years, my property has already doubled in value. So now it's worth $400,000. So if I would have waited, I would have had to put down $80,000 as opposed to a couple of years ago, just rolling in with the minimum down payment. So there's a lot to consider with this question. At the end of the day, you know your situation best, so you just have to come up with the pros and cons. So I hope you found this helpful. Again, if you have any questions or you want to run through different scenarios that's more tailored to you and your situation, give me a call. My number is 407-773-1775, or you can book a call with me. The link is in the description, and I'll see you